All right. I'm pretty sure the stock market crash that we've been expecting has probably started, but I'm going to warn this is not going to be an easy move down. The governments and the plunge protection team are going to intervene aggressively to try and stop this selling in the stock market. This is why I've been saying for weeks that not to try and pick a top. The natural top occurred right here. This daily cycle was ready to roll over, left translate. This was early January. The market was already aware that there was going to be a problem with the coronavirus, but the market wasn't allowed to discount that naturally, like it would have in a free market. The market would have rolled over here, come down, and we would have had a milder, although longer duration correction. But governments intervened. We got this violent V-shaped reversal, and they continued to pump more and more money in. Market tried to correct again here. More billions of dollars pumped into the market. More market interventions, and all they have done is made the problem worse. The reason being is they have allowed the market to stretch way too far above the long-term moving average. So here's the 200-day moving average. And while, again, like I said, I fully expect there to be multiple and aggressive interventions to try and stop the stock market from selling off. So we're going to have convincing looking bounces along the way. We're only, I think, 15 days into this daily cycle. Normal duration is 30 to 40 days. So we've probably got a ways to go. And a normal intermediate decline will typically have a very aggressive first leg down, and then a bounce, and then a second wave down. So here's a classic example. This was the A wave decline, reaction, bounce from oversold conditions, and then the second leg down. So in a normal sell-off, that would be what we would expect to occur. Um, we're probably going to get something similar, although I expect there'll be much more intervention, aggressive interventions to try and stop this sell-off along the way. But uh, because the Fed pumped this up way too long, too far above the moving averages, stopped the normal um, selling that was starting right here, and prolonged this another over a month longer than it should have run, um, it's probably going to be worse. So at a very bare minimum, um, based on how far this price is stretched above the 200-day moving average, you've got to think that eventually we're going to come back down to test this 200-day moving average, and in reality, we probably should go below it. All the money printing and intervention cannot stop the virus from slowing down the global economy. This is actually the one scenario that might cause a mild global recession, other than a spike in energy. If everybody just gets scared and they stay inside and they don't spend money, that would be an event that could collapse middle class spending, and that could cause a recession. So there is a potential driver for a mild recession. It's not going to be the end of the bull market. Like, we're going to see a lot of perma bears, especially if this crash continues. If the selling overwhelms the plunge protection team efforts to keep the market propped up, and we come down um, and tag the 200-day moving average, and especially if we go considerably below it, there are going to be lots of perma bears calling for the end of the bull market again, like they always do at every one of these intermediate events. But it's not going to be. This is just a long overdue profit-taking event with the off chance that the coronavirus may trigger a mild recession. We had a recession during the last bull market in 1990. It didn't stop the bull market because it didn't stop the innovation cycle. And the same thing will apply here. Even if we were to get a mild recession, it's not going to stop the innovation cycle. and it's not going to stop this bull market. So, this is going to probably be a very, very tough trade to trade from the short side because, like I said, we're going to get lots of interventions to try and turn this back up. They're going to look convincing, and somewhere here we should get a very convincing counter trend bounce, similar to what happened here before rolling over and producing the second leg down. So this is why I've been saying all along, don't try and pick a top. The Fed will keep this propped up probably longer than you anticipate, and they're going to make it very difficult to hold onto positions on the way down. So don't try and pick tops, and I wouldn't even really waste my time trying to short this. I would just wait patiently for some sign that a bottom is formed, and then that would be your buying opportunity for the next leg up. And until we get much deeper into this daily cycle, I would say minimum of day 30, I would not try and pick a bottom until we get at least that far into the daily cycle. And I would probably be hesitant to try and pick a bottom until we at least test this 200-day moving average and maybe come back down to retest this breakout right here. And if I move to the weekly chart, you can see it's even more extreme. The Fed created a mini bubble, not a true bubble, but a mini bubble with their QE and their efforts to prevent the market from correcting naturally when the coronavirus infection began. You can see this vividly in the chart of Apple, just how extreme the move above the 200-week moving average has become. Look at the same thing in the NASDAQ. There is a slight possibility, and if the coronavirus does trigger a recession, then I would say a good possibility that we could even come back down to test this 200-week moving average, and this would turn into the true 4-year cycle low. Remember in my past videos, I noted that this, right at this moment anyway, this looks like the 4-year cycle low. The problem is that it occurred really, really early, not even 3 full years into the multi-year cycle. So possibility that this could turn into a major crash that could take the market back down to this 200-week moving average if we were to get a mild recession, and then that would turn into the true 4-year cycle low. So no need to be in a big hurry to try and pick a bottom in the stock market, even though we're going to see convincing bounces as governments try to intervene and stop the selling pressure in the stock markets. But like I said, that all of the stock market intervention in the world is not going to stop the virus from continuing to spread. And if it does continue to spread, then there is risk of a potential mild recession. And in that case, I don't think the plunge protection team will be able to completely stop the selling in the stock market.